have Jim Paulsen. He's the chief investment strategist at Wells Capital Management and helps oversee $375 billion in assets. And he joins us from Minneapolis, Minnesota. Jim, good to see you once again. Now, you've been a bull for a while. What about how the markets are setting up for this Fed decision? Are we going to get more monetary easing, or could the markets and investors be disappointed here?
Well, I agree with Ethan quite a bit. I think we're going to get lip service from the Fed that the economy has slowed down, but I don't think it's slowed enough for them to involve themselves with any further action right now. I'm not even sure, Susan, if the market's putting that much into behind the bet that they're going to do something like lower rates or even purchase more mortgage backs. I really think most people expect some admission that the economy slowed, and a little more than that. I think the market is responding to the fact that there's some early indications here that the economic momentum might be picking up again. The last 2 weeks, the ECRI weekly leading indicators have turned up for the first time since the soft patch here in the United States started. We got a little better ISM services report, and even manufacturing reports of late that have been better. And even the jobs number, for as bad as it was, suggests that personal income and industrial production for this month are going to be up maybe 0.5%. So there are some things in the real economy that are starting to improve. I think that's what's causing this market to continue to go up.
Okay, so that's the bounce that we're seeing on the markets, Jim, and not expectations of more monetary easing coming from the Fed. You don't think that's being priced in?
I don't think so. I really don't think so yet. I think that people are still on the fence. If we continue to get bad unemployment reports, or if the unemployment claims, Susan, which will come out Thursday, if they continue to go up towards 500,000, then you're going to see a lot of expectation of additional Fed easing. But I think at this point, for tomorrow's meeting, I don't think markets have much expectation they'll do much more than just an admission that the economy is slower.
Now, Jim, as I mentioned, you've been a bull for a while, even during the sell-off that we saw in the last few months leading up to this summer rally. But what about the cheapness of U.S. stocks right now? You know, we've seen a lot of investors try to pile into bonds to get more of a safe haven investment. But as you mentioned, you know, stocks are looking pretty cheap right now, especially in comparison to fixed income.
It's in comparison to the 10-year bond, it's amazing. We've got the stock market, the S&P 500 in this country, selling at around 13 times forward earnings. We've got the 10-year Treasury tonight selling above 35 times its one-year coupon payment. So normally the stock market PE will be higher than the price to coupon on the bond. So we're in a pretty unprecedented situation with stocks relative to bonds right now. And from that standpoint, from a longer term view, it's screaming that bonds are the place to, or excuse me, stocks are the place to be relative to bonds. I think ultimately, if we show in this country over the next few months that there are more jobs being created, then you're going to see a pretty sizable move, not only upward in the stock market, but I think upward in the Treasury bond market as well.
Okay, and you said it may look fairly ridiculous if the economic recovery actually proves to be sustainable for those getting into the expensive bonds right now. So if this is the time to play aggressive, what would you be getting into? Is it the time to play aggressive, get into these cyclicals?
I think it is. I think it's certainly being more maximally weighted stocks relative to your bond weighting. I think that should be for most players within the stock portfolio. I think be more cyclically orientated. I mean, right now, if we do show that the economic recovery continues and the economic growth rate accelerates a little bit again, then flows are going to come back, not to the defensive stocks. They're going to come back to the more economically sensitive areas. I think I throw out 4 different sectors right now that are interesting. I think 2 that have been doing well in the last month. The basic material stocks and the industrials have picked up just in the last month off the lows of this rally starting in early July. I think they still have further to go, being the primary beneficiary of a lower dollar, which has started to happen in the United States. 2 sectors which haven't been doing as well that I think you could look at right now are the tech sector, which sits right at the epicenter of the best balance sheets in the business community that we've had for some time. And I'm starting to get more interested again, after not being there, for the consumer discretionary stocks. If we're going to recover with some job creation, then the consumer, I think, might come back and surprise us a little bit here over the next several months.
Okay, Jim, hopefully I'll talk to you again this summer. Nice to see you. Jim Paulsen, Chief Investment Strategist at Wells
you.
Capital Management, joining us there from Minneapolis, Minnesota.